Howdy, everybody. Welcome to Liberty Call. Today is Monday, August 12th, 2024. Hope you're having a fantastical day out there and a great weekend. My Stros actually swept the Sox. I can't believe it. It is unbelievable. So they played exceptionally good over the weekend, but they typically do up in Boston. So next they're headed down to Tampa, which they don't always play real good in the Trop. So let's, cross our fingers and, hope everything goes well for this next three games. So anyways, hope you're having a great day. It's a little gloomy now here in Colorado. We had sun out earlier, but looks like it's got some more clouds and probably some more rain, which we're not really going to complain about. All right. Well, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, follow, and press that notification bell. All right. Let's get into the markets for today. Dow Jones down 0.36%, 140 points, closed at 39,357. The S&P 500 flat down or up 0.03%, 1.45 points, closed at 53,445. Nasdaq up 0.22%, 37 points, closed at 16,782. The VIX was up today 1.82%. It's at 2074. Canada up 0.39, Brazil up 0.5%, and Mexico down 0.04. In Europe, Germany was down 0.06, the UK up 0.52, France down 0.26, the Netherlands up 0.26, Spain up 0.07, Italy up 0.46, Switzerland up 0.23, and Portugal up 0.09. Russian exchanges split today. The MOEX up 0.02, the RTSI down 3.74. Is there motion in my driveway? Wonder if it's a bear. Could it be a bear? Let's look. No, it's the Amazon guy. Anyways. All right. Getting back into it. Where were we? Oh, we just covered Russia. The overnights, the Nikkei in Japan was up 0.56%. Australia up 0.46%. New Zealand up 0.56%. In China, the Shanghai was down 0.14%. The Shenzhen component down 0.24%. China A50 up 0.05%. DJ Shanghai down 0.24%, Hang Seng up 0.13%, and the Taiwan weighted up, closed on the 9th, 2.87%. All right, so those are the markets for today. Exciting, isn't it? I know. All right, let's get to the weekly economic update. Stocks ended last week with modest losses, masking a volatile 5-day trading period, which saw investors embrace recession concerns and then dismiss the slowdown talk as speculation as the week progressed. The Dow Jones slipped 0.6%, while the S&P ended the week flat, down 0.04%. NASDAQ dipped 0.18%, and overseas fell 1.21%. Stocks stage a comeback. Monday was the worst day of the S&P 500 and the Dow in nearly 2 years as recession talks grew louder. Investors took a risk-off position. On Monday, the Japanese market had its worst drop since 1987 as market participants unwound positions from the popular trading strategy called a carry trade amid a global sell-off in stock prices. So basically, if you don't know what a carry trade is, it's where you will take and you'll have both sides of a currency trade where, say, you have the dollar in one trade and then you have the yen in the other, where the dollar's paying like, what's the Fed funds rate, like 5.25%, and the Japanese rate is 0. So basically, you make the difference in that spread. Well, when the Japanese started raising rates, it started, messing up all the calculations. People had margin calls and all sorts of problems. So that's what really created a lot of the problems at the beginning of last week. So whether or not that's going to happen again, I don't know. All right, where were we? But on Thursday, initial jobless claims fell less than expected, a positive sign for the labor markets. 1 week it's bad, next week it's good. Everybody just fly by night, whatever the latest report says, that's what they go with. But on Thursday, where was I? Oh, yeah, already covered that. Also, as the week progressed, there was growing speculation that the July jobs report was more of an outlier than the lead indicator of a pending recession. By Friday's close, all three major averages had regained most of the weekly losses. All right, a mortgage update. Last Thursday, the average rate on the 30-year fixed mortgage dropped to 6.47%, a 15-month low. Many buyers welcomed the news as it appeared to help support Thursday's rally. but the announcement left some wondering whether rates would continue to trend lower. Mortgage rates are tied to the interest rates set by the Federal Reserve. Some speculated the drop was due to market participants anticipating that the Fed would adjust rates in September, which remains anything but certain. Key economic data this week. On Tuesday, we have the Producer Price Index, the PPI, and Fed official Raphael Bostic is speaking. Wednesday, the Consumer Price Index, the CPI, and the EIA Petroleum Status Report. Thursday is jobless claims, retail sales, industrial production, business inventories, and Fed officials Alberto Musalem, that's a name I've never seen, and Patrick Harker speak. Friday, housing starts and permits, consumer sentiments, and Fed official Austin Goolsbee speaks. So I would probably tune in for that because he's one of the dumbest humans on the planet, and he's always entertaining to listen to. All right, companies reporting earnings this week. Tuesday, Home Depot, which I made a purchase there over the weekend. You're welcome. Wednesday, Cisco Systems. Thursday is Walmart, Applied Materials, and John Deere for you tractor enthusiasts out there. All right, so that is the weekly update. Let's hop over to the market recap. S&P 500 struggles for direction ahead of key inflation data. The S&P 500 wavered on Monday as investors anticipated key consumer price index inflation data due later in the week. This data is expected to show a slight cooling in July, is crucial as it could influence the Federal Reserve's decision on whether to cut interest rates in September. The central bank is widely expected to begin reducing rates amid signs of a cooling U.S. economy, though there is uncertainty about whether the cut will be 25 or 50 basis points. That's 0.25% or 0.5% for you normal people. The Fed has indicated that further positive economic data could solidify the case for a September rate cut, even if inflation hasn't reached the 2% annual target, which it's not. Morgan Stanley highlighted the risks associated with the CPI data, noting that a high reading could spark fears of stagflation, while a low reading could fuel concerns about a hard landing for the economy. Nonetheless, the firm expects the inflation trend to continue its downward trajectory. As the earnings season winds down, a few notable companies are set to report, including Home Depot and Cisco. According to FactSet, the earnings season has been largely positive, with 78% of S&P 500 companies that have reported so far posting a positive earnings surprise. In individual stock news, JetBlue Airways dropped 21% after announcing plans to sell $400 million in convertible senior notes. KeyCorp saw an 8% rise following the Bank of Nova Scotia's $2.6 billion bid for a 14.9% stake. B. Riley Financial plunged 52% after forecasting a significant Q2 net loss and suspending its dividend. Starbucks gained 2% on reports that Elliott Investment Management, which has been advocating for changes at the company, is close to securing a board seat. All right. So everyone's just on their edge about cutting rates. And, it's like Christmas. You run down the stairs. Oh, tear open the packages. They're going to be low rates. Oh, it's cold. Darn. Okay. Well, let's get on to the next article. This one comes from Zero Hedge. Credit card and auto delinquencies surged in the second quarter. That is not good news. Credit card debt delinquency is on the rise, with over 10% of outstanding credit card debt now more than 90 days delinquent, according to recent data from the New York Fed's quarterly report on household debt and credit. This significant increase in delinquency is a growing concern for banks, which may soon curtail credit as a result. The rise in delinquencies is not limited to credit cards. Auto loan delinquencies have also increased, particularly among younger borrowers. The Consumer Financial Protection Bureau has highlighted that the current delinquency rates are even higher than in 2019, primarily because lenders took on more risk in recent years. During the pandemic, lending standards loosened. That's always a good idea, leading to the issuance of credit cards to riskier consumers. This, combined with pandemic-related financial aid and forced savings, pushed average credit scores up, creating a false sense of security among lenders. Yeah, having spent about 2 years at a high-risk credit company, wow, those are fun to collect from because they don't care. All right, jumping back in. As a result, credit cards issued between 2021 and 23 have gone delinquent at a much faster rate than those issued in previous years. For instance, about 8% of credit cards issued in 2021 became delinquent within just 2 years, compared to 4 years for cards issued in 2016. This rapid increase in delinquencies is particularly pronounced among younger generations, such as millennials and Gen Z, but it affects all age groups to varying degrees. The rising credit stress comes at a time when layoffs are increasing and it's becoming harder to find a job, exacerbating financial difficulties for many. Despite some positive economic indicators such as job growth, there is growing concern that these figures may be overstated and that a recession could be looming. Economists are now debating the potential for significant job growth revisions, which could further paint a bleak picture of the U.S. economy's current state. Well, that is awesome news. All right. I got one more article here. Well, I got two more articles, but one more from Zero Hedge. This one titled, "These 6 Drivers Are Gone, and That's Why the Global Economy is Toast." This was authored by Charles Hughes Smith of Two Minds blog. So let's see what he has to say. The global economy is in a precarious state, driven by reversals of 6 key factors that once fueled growth, according to Charles Smith. These factors, China's rapid industrialization, favorable demographics, low interest rates, manageable debt levels, low inflation, and a tech-heavy productivity boom, these right here on the screen, are no longer present, leaving the global economy vulnerable to a deep recession. China's role as a global economic savior, which helped pull the world out of past recessions, is now diminished. The country has moved past its high-growth phase, and its economic model, once driven by industrialization and exports, is now faltering under the weight of overproduction and a shrinking workforce. The demographic challenges and over-reliance on real estate as a wealth vehicle exacerbate this decline. The era of low interest rates and abundant liquidity is also over, with governments facing unsustainable debt levels. As interest rates rise, the cost of servicing debt will crowd out other government spending, leading to economic stagnation. Meanwhile, inflation is no longer under control, driven by rising wages, resource costs, and the reversal of offshoring trends. The once promising tech productivity boom has also run its course, with AI touted as the next big driver of growth. However, Smith argues that AI may either fail to deliver on its promises or exacerbate economic inequality by displacing millions of white-collar workers without creating new jobs. In this environment, the global economy is highly fragile, over-leveraged, and vulnerable to collapse. The concentration of assets and risk, combined with speculative bubbles and corruption, has created an unsustainable system. As the world slides into recession and possibly a broader polycrisis, Smith concludes that the global economy is toast, in quotes, with the only distribution of the burned bits remaining. So, well, that's some positive news if I've heard it. Wow. Pretty scathing there. So, all right, one more piece of news here. This comes via First Trust, the week ahead, from Mr. Brian Westbury. So let's finish off the broadcast with this. All right, this week in August is critical for economic data, with key reports on consumer price inflation, producer prices, retail sales, industrial production, housing starts, and unemployment claims being released. The overall picture suggests that the broader U.S. economy is decelerating as effects of the Federal Reserve's tighter monetary policy enacted over the past 2 years finally begin to take hold. The slowdown has been delayed due to the unique circumstances surrounding the COVID-19 lockdowns and reopening, the massive monetary stimulus that preceded the tightening, and the unusual federal budget deficit expansion last year despite low unemployment, and Supreme Court decision on student loans that artificially reduced the official deficit. Recent economic reports indicate a decline in construction, slower job growth, and mixed ISM indexes, with manufacturing signaling contraction, while the services sector remains slightly positive. This week's data is expected to show that both consumer and producer prices rose by about 0.2% in July, which, while better than recent years' higher inflation rates, suggests that tighter monetary policy may be starting to work. However, this trend may not be permanent, as the Federal Reserve is likely to loosen policy again in the near future, potentially driving inflation higher. Yeah, because when they start lowering rates, that is an inflation driver. Pushing rates up brings inflation down. So we shall see what happens. And I know the Fed probably is just going to lower rates simply because Wall Street's been banging on their door, the federal government, because debt servicing on the government level. So, we're kind of caught in this catch-22. If we push rates way, way, way up to reduce inflation, then, it slows down the economy. It creates more of a stagnation environment. But if we do what we've been doing the last 15, 20 years, keeping rates as low as possible, then the inflation, while it doesn't build like it did real fast in 2020, it's that thief in the night that, from one year to the next, everything is, 2 to 3% more expensive. And then after, 36 years, everything is doubled. So anyways, all right, get back in here. Retail sales and industrial production data are expected to present a mixed picture. A rebound in auto sales is likely to push retail sales higher, but only marginally, as year-over-year growth remains minimal. On the other hand, industrial production is anticipated to decline, particularly in the manufacturing sector, signaling potential trouble ahead. While the U.S. is not in a recession, the economic outlook is becoming increasingly uncertain, with tight monetary policy and tightening capital standards for banks signaling potential changes. The situation is reminiscent of the 1970s stagflation, with slow economic growth and persistent inflation above the 2% level that many have mistakenly viewed as stable. The U.S. economy finds itself in a precarious position, whether further government intervention is being demanded, but the experimental policies of the Fed and Treasury make the future difficult to predict. All right, so that is all the news that's fit to be talked about today. So, all right. Well, if anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. So if you have trouble with your finances, give me a call. I'd be happy to get you back on track. All right. Well, I hope everyone has a wonderful evening. We'll see if it's going to rain here, and maybe Jake and I can get some ball time in before the sky opens up. Probably. I mean, he doesn't play long outside. He plays like 5 to 10 minutes, running up and down the hill, and then he comes inside and then brings me another ball and says, "Here, throw it down the stairs." So he's a strange animal. All right. Well, I hope everyone has a fantastical evening, and I shall talk to all y'all again next time. Adios.